India's growth trajectory is looking firm. High-frequency indicators from the government are pointing to not just stability, but a conducive growth environment. This has prompted agencies across the board to revise their growth forecasts upwards, not just for the previous fiscal, but for the current year as well. Sapna reports that while data points do encourage optimism about the economy's prospects for the next year, there are still some challenges that have to be overcome.
The Indian economy is on solid ground if most of the data coming in is to be believed.
Auto sales are in top gear almost across the board, whether it's two-wheelers or four-wheelers. The stock markets are soaring, with retail investors showing they are keen on riding the wave. Other economic indicators are also upbeat, whether it's a strong PMI for manufacturing and services, or IMD forecast of an above-normal monsoon, or a surge in bank credit led by rising demand for personal loans, or a rise in household savings in physical assets. All this has sparked optimism about India's growth prospects for the current fiscal. Growth estimates from global agencies range from 6.6% to 7%. Within the government, however, expectation is that even a 7% forecast may prove to be conservative if the monsoons and geopolitics lend a hand. As Chief Economic Advisor V. Anant Nageswaran put it, beyond FY25, the omens are good for us to continue the steady growth of 6.5 to 7%.
But beating the 7% number consistently means overcoming some major obstacles. The Chief Economic Advisor himself has listed a few solutions like boosting investments, lesser compliance, more deregulation, and a skilled labor force for higher productivity and to be more future ready.
These impediments to a sustained 7% plus growth are not the only ones. Take, for instance, private capital formation. The share of this in gross fixed capital formation appears to be stagnant. The pace at which private capex, which fell off a cliff during the pandemic, is reviving also needs to be quicker. In contrast, the share of households in capital formation has increased by 1 percentage point to 40.5%. The government's contribution in capital formation has also increased, though the share of public sector companies has dipped by 100 basis points. The government's manufacturing push has also been slow to translate into results. The share of manufacturing in GVA continues to be patchy. Agriculture's share, meanwhile, has slipped steadily in the last 2 financial years, though it still remains the largest source of employment. Even in the arena of job creation, the manufacturing sector does not appear to be doing too well. It accounts for just 11.4% of jobs. That's one of the lowest industry-wise, even lower than construction, trade, hotels and restaurants. The periodic Labour Force Survey 2022-2023 says self-employment is becoming the largest job creator, accounting for over 57% of jobs created in FY23 from just under 56% in FY22. However, more jobs does not mean better pay. PLFS 2022-2023 shows that while average monthly wages have risen by 1,200 rupees under salaried employment, earnings by self-employed and casual labour have actually fallen. The other big challenge will be for India to speed up getting out of debt. An analysis by the NCAER says interest payments by both the central and states make up close to 5% of the country's GDP, and almost a quarter of all revenues earned go just towards servicing debt. So, bringing this down and redeploying the money to areas which can speed up growth and job creation will have to become a priority. In New Delhi, Sapna Das.
Well, a task set for the next government. With that